The Federal Reserve, commonly known as the Fed, is the central banking system of the United States, established by the Federal Reserve Act of 1913 in response to financial panics. Its structure balances public and private interests as well as centralization and decentralization of power. At the top is the Board of Governors, the main governing body. It consists of 7 members appointed by the President and confirmed by the Senate, serving staggered 14-year terms to ensure continuity and independence from political pressures. The chair and vice chair of the board are appointed from among the members and serve 4-year terms. The board is responsible for formulating monetary policy, supervising and regulating banks, and conducting economic research. There are 12 regional Federal Reserve banks, each serving a specific U.S. district. These banks operate independently within the Federal Reserve System and act as its operating arms. Each reserve bank has a president appointed by its board of directors and approved by the Board of Governors. The boards are made up of 3 classes: Class A, representing member banks; Class B, representing the public with interests in agriculture, commerce, industry, services, labor, and consumers; and Class C, appointed by the Board of Governors to represent the public. The reserve banks implement monetary policy at the regional level, provide financial services to depository institutions, the U.S. government, and foreign official institutions, supervise and regulate banks within their districts, and conduct economic research. The Federal Open Market Committee, FOMC, oversees open market operations, the principal tools of national monetary policy. It is composed of 12 members, the 7 Board of Governors members, the President of the Federal Reserve Bank of New York, and 4 of the remaining 11 Reserve Bank presidents, who serve 1-year terms on a rotating basis. The FOMC sets targets for the federal funds rate, conducts open market operations to influence money supply and interest rates, and guides the overall direction of monetary policy. National banks are required to be members of the Federal Reserve System, while state-chartered banks have the option to join. Member banks hold stock in their regional Federal Reserve Bank and receive dividends. They contribute to the capital of the reserve banks and have a voice in electing the Reserve Bank's board of directors. Several advisory councils provide input on the Federal Reserve System's operations and policies. These include the Federal Advisory Council, FAC, which consists of representatives from each of the 12 Reserve Bank districts and meets quarterly with the Board of Governors. The Community Depository Institutions Advisory Council, CDIAC, offering perspectives on the economy, lending conditions, and other issues facing community banks, credit unions, and savings institutions. And the Model Validation Council, which provides expert advice on the Fed's models and risk management. The Fed operates independently within the government, not relying on congressional appropriations for funding. It generates income primarily from interest on government securities it holds. This independence ensures that decisions are made based on economic considerations rather than political ones. However, the Fed's independence is balanced by its accountability to Congress, to which it reports regularly on its activities and monetary policy. Transparency is maintained through regular reports to Congress, public speeches, and publications, ensuring accountability and public trust. This structure allows the Federal Reserve to manage the nation's monetary policy, supervise and regulate banking institutions, maintain financial stability, and provide banking services to depository institutions and the federal government.